Tired of watching your dream home slip further and further away thanks to sky-high mortgage rates? Well, I've got some good news for you. The Fed is about to make a move that could put you back in the driver's seat. An interest rate cut is right around the corner. But the real question is, will the Fed lowering the Fed funds rate actually lead to lower mortgage rates when that happens? And that's exactly what we're going to talk about in today's video as we cover what you can expect when the Fed actually makes the cut, along with what you should pay attention to moving forward when it comes to mortgage rates. Based on the CME Watch Tool that you see here, this is the probability that the Fed is actually going to cut rates at some point in the future. Now, this is real traders putting up real money making these bets. And at the moment, there's a 100% probability that the Fed is going to make an interest rate cut come September 18th. But the real question at hand at the moment is it going to be 25 basis points or 50 basis points? As you can see from this chart here, they're pricing in a 70% chance at the moment that it's going to be 25 basis points, while the other 30% are betting on 50 basis points. But here's the real kicker. They're actually pricing in 100 basis points between now and the end of the year, and there's only 3 Fed meetings left, which means if those probabilities are accurate, they are going to have to cut at least 50 basis points in one of those meetings in order to get down to 100 basis points. But with that, there's a big misconception in what happens when the Fed actually starts cutting rates. When the Fed cuts 25 basis points or 50 basis points or even 100 basis points, does that mean mortgage rates fall by the same amount? And the simple answer is no. And the main reason for that is because the Fed funds rate isn't directly correlated to mortgage rates. The Fed funds rate is the overnight rate in which banks lend excess funds to one another, which in layman terms basically means it affects things like student loans, car payments, credit cards. Whereas on the flip side, mortgage rates are actually tied to treasuries and mortgage-backed securities. So going back to that question I asked earlier about the Fed lowering rates and that directly trickling into mortgage rates, is that going to happen immediately? And my answer is no. And the primary reason for that is because a lot of that's already built into the current predictions. Fed Chair Powell recently came out indicating that interest rate cuts were ahead, saying that the time has come for policy to adjust. And the market's reaction to that was that the Fed is about to pivot, which in turn means they're going to start lowering the Fed funds rate. And because the Fed has already come out and said that, they've been transparent in what they're trying to do, the market knows that that's coming and they're already pricing it into where interest rates are today. So for all of you sitting on the sidelines at the moment, or those of you in contract waiting to lock a rate, understand that when the Fed comes out on September 18th and they announce a rate cut, you're not likely to see mortgage rates move down in any meaningful way. And that's because the Fed already told you this was coming. In fact, what we have to pay attention to is what the Fed actually says in the press conference afterwards, because that gives us a better indication of what to expect going forward. Now, I realize at the time you watch this video, the Fed meeting is still about 3 weeks away. So the question is, what is the Fed actually paying attention to that's going to decide whether or not they cut 25 or 50 basis points at that September meeting? Well, the easy answer is what's happening with employment. Now, we all know the Fed has a dual mandate: price stability and maximum employment. And based on the Fed's favorite indicator that was just released, PCE came in at 0.2% month over month, which is exactly what the market was expecting, with core PCE coming in at 2.6% versus the 2.7% forecast. In fact, the unrounded number was 0.16%, which annualizes at a perfect 2%, which is exactly what the Fed is looking for. And despite this good news, we actually saw the bond market move in the wrong direction. And that's because the market already knows that inflation is more or less under control, and that the Fed is giving a heavier weight to the employment side of things when deciding on exactly how much they're going to cut by. Now, right after you watch this video, we have some huge employment information coming out. We have the JOLTS numbers, which tells us how many openings are out there in the market, along with ADP data reporting on Wednesday, along with the big report, the BLM numbers coming on Friday. Now, the key with those reports is if unemployment rises, if job openings actually go down, that in turn shows that the market is actually slowing, which gives the Fed further need to cut more sooner than later. Now, one thing I want to be very, very clear on, just because unemployment numbers come in worse than expected doesn't necessarily mean rates are going to fall at that time. In fact, I think we're kind of on this slow trickle downward where you don't necessarily see big moves in one day. Now, I'm still in the camp that we're going to see an interest rate with a 5 handle on it by the end of 2024. Now, is that 5.9 or 5.75? It's really hard to say. But I do see the employment numbers getting worse. In fact, the revisions are getting worse. And with this, we've seen the 10-year improve. We've seen the spread between the 30-year and the 10-year improve. And with those both trending lower, we're going to continue to see mortgage rates move down. But here's the thing, we still have an affordability issue, which is one of the reasons that we saw pending home sales drop to 5.5% in July, which is an all-time low. Even though mortgage rates are likely going to continue to trend lower, I would encourage you not to try and get fixated on getting the absolute lowest rate, but rather focus on buying when it's the right time in your life versus trying to pick the top or the bottom, because that's an absolute fool's game. But at the same time, if you're out there in the market shopping for a loan and you're afraid to lock right now, you're not sure whether you should lock right now, just talk to your mortgage professional. Get on a list. Tell them that you want to be updated when big moves happen in the market so that they can reach out to you and let you know exactly what's going on. But with that, I'd love to know what you think is going to happen with mortgage rates. When the Fed cuts in September, do you actually think they're going to cut? I guess is a better question. And if you think they're going to cut, are they going to cut by 25 basis points or 50 basis points? And on the flip side, if you don't think they're going to cut at all, do me a favor and let me know why in the comments below. The last thing I want to address is people asking the question of, well, when mortgage rates go lower, that means prices are going to skyrocket again, right? And honestly, my belief is no. I don't think prices are going to skyrocket again because affordability is such a big issue out there. Even with mortgage rates moving down into the fives, that is not going to have a big enough impact on affordability, in my opinion, to drive prices up, at least in most markets out there, because supply has increased out there. And we always go back to supply and demand, where if you're in a market now that has supply back to 2019 levels, which 8 states currently do, then you're less likely to see prices shoot up in those markets as mortgage rates come down. But in turn, that could provide some stability in that market where you don't see prices go any lower. But what happens in those markets where supply is still low? Don't prices shoot up there? I don't think so. I think you do see prices continue to go sideways to up, but only by a moderate amount. I'm thinking 2 to 3%. Now that will cause some more sellers to come to the market as mortgage rates come down, and those sellers are also buyers, so that will create some more demand there. But I'm not sure we're going to see this huge jump in buyer demand with interest rates only coming down into the high 5% range. But if interest rates can continue to trend lower into the low 5s, into the high 4s, then that in turn could create even more demand, pushing prices even higher. But the question at the moment is, how much are mortgage rates actually going to go down? I'm curious to know your opinion. Do me a favor and let me know in the comments below.